How much are we pricing in those rate cuts next year to continue to rally in the Treasury space?
I think really right now Wall Street is looking at something even within the first half of the year. We've seen different expectations, different polls, but right now we really do see a pricing in where they're expecting it rather soon. Now, we may be disappointed. We've certainly heard a lot of dovish comments, but it's all about staying stable. And given the unemployment rate and where we are still, well within the 3%, really sort of stuck at that 3% inflation rate, we might have to wait until the second half of the year before we see it, to be known. But for now, the optimism is there. And certainly the bond market is treating it as if they expect cuts sooner rather than later.
It's really interesting because we're seeing also the optimism over the broader economy, right? With the shopping season right now, we're headed into the holidays. Where do you position as we perhaps might see a Santa Claus rally?
Yes, and I think even within consumer discretionary, I think there are some opportunities, very stock specific. I'm not saying across the board consumer cyclicals, but we really have been seeing a growing trend in some of the retailers. So some of the smaller items, things you don't have to finance, obviously, but there are just some unique brands that are really able to sell well, and we've seen that really help their sales and help their stock prices as we see some positive news from the consumer area.
So far, we have seen these large companies being able to absorb the hit from rising prices, right? What about the smaller companies, small and mid caps? They've been out of favor for a while now. Can they come back in vogue?
I do believe so, although we've been waiting for 2 years. I mean, it's over a 2-year underperformance. And, they have been able to maintain their margins. We've seen a lot of these, particularly your bigger small caps, but being able to maintain margins, maintain profitability, maintain revenues, because the U.S. consumer has been so willing to spend. And they have been able to pass on these prices. And really the only thing that's come down is their valuations, like their forward PEs or historical PEs, as they just get more and more compressed as they continue to underperform your large caps. And so I know a lot of us, particularly when you're looking at asset allocation, you just look at these valuations and say, like, these guys are on sale. It's so cheap. And just waiting for that turnaround. But again, it's all about that bond market. The yields have to come down, and some of that confidence has to come back up.
Can you go down the market cap level in order to get some of that diversification within the growth space?
Yes, and that's one thing that, there are some small caps that have been performing well. Anything that's high margin, high cash flow, in particular software services in the S&P mid cap is up about 33% year to date. Now, that does sound great. That is still below the same industry in the S&P 500. But when you do look, there are some winners, and certainly if you're ready for some diversification, if you feel like your valuations are a little top heavy and you want to sort of take some money off the mega cap area, because that's so much of what we're looking in the large caps, I think there's some really great opportunities. But I'd be very cautious about anything that has high debt levels. You're really looking for those high margin, high cash flow companies like software, those types of services.
When it comes to potential value and bargains that might be found, we have seen the MSCI Asia Pacific, for example, the index gaining 3% as opposed to the MSCI World that's double-digit gains this year already. Yep. Are there any sectors overseas that might appeal to you where the risk premium is not that high?
That's difficult because for so long there seemed to be so many opportunities, particularly within the China investment space, and right now with just considering the headwinds around the negative economics, I think there are selective opportunities if you're really willing to take more high risk bets within the AI space, within China, but again very high risk, but they have been so beaten up, and so they do look like there's some opportunities there.
Do you play into a dollar strength now? We're seeing dollar weakness. How do you position, especially in those multinationals that have to operate overseas as well?
You know, I've really been looking on top of, as we've seen dollar weakness, how that might make particularly more some of the European stocks look more attractive as the euros really gain strength. But because their outlook and their revenue growth has been so poor, we still see actually continued underperformance. And I'd actually still rather prefer like a U.S. small cap or mid cap that has less international exposure to just sort of mitigate any weakness from outside the U.S. But right now, that change, unless you're investing directly in futures, I'm not taking into account as an investment play for an asset allocation portion just yet.